Welcome to part 3 of Income Tax Update for Landlords. We will now talk about rental expenses, depreciation, Schedule E, COVID-19 update, and what to do about unpaid rent. So let's get started with expenses now.
Now talk about the tax deductible expenses you have. As I said, we got a lot of calls on what the income side. We occasionally get a call on what do I get to deduct. So the rule in the tax world is that to be deductible, expenses must be customary and reasonable along with ordinary and necessary. So if I buy all my tenants a $3,000 of Dom Perignon champagne every year because they're great tenants, and I give that to them, that would not be considered customary and reasonable along with ordinary and necessary. I might be able to give them a bottle of sparkling Muscatel for $9.99, not a problem, but that's $9.99. A revenue officer is going to say that gift is unreasonable, especially if my tenants are only paying me $12,000 or $15,000 a year. That would not be ordinary and customary. Normally, landlords don't do that, and it wouldn't be reasonable. So there are other things that might be, but you need to be reasonable. I cannot take all my rental tenants out to the top of the town restaurant and buy them dinner every month because they paid their rent. So needs to be, and I can't fly to London to look at London rentals because I want to see how they do business there. So just be thinking about that. Some of these expenses include things like amortization. The points on the mortgage that I paid might have to be amortized over time. Goodwill, if I bought anything that had some kind of goodwill or intangible asset, may have to be amortized over time. Cleaning and maintenance. Any cleaning and maintenance I do would absolutely be deductible. Commissions that I pay to get tenants, to realtors or others, that might even be under that heading, referral fees. I pay my tenant in Unit A to refer me tenants for Unit B and C because they're good tenants and hopefully they'll find people to live next to them that are good people just like them. Depreciation. So, and I'm going to talk a little bit more about depreciation in a minute, but depreciation, the government says if you have a residential rental property and you live in it, it will stand up forever and go up in value. As soon as you put a tenant in that property, they say it's going to fall down in 27 and a half years. And they let you write off the value of that property. They depreciate it, write down how much it goes down in value according to their chart every year. And that's depreciation. It's the supposed tax decrease in value. Now, we all know that property tends to go up in value, so you may have to recover that. But depreciation can be complex. I'll talk a little bit more about that in a minute. Insurance on the property, including, we've just found there are some insurance policies that you buy laws coverage in case something happens and you have to fight the city or the zoning. But any insurance that you buy that's directly related to the property or the liability from the property. Legal and professional fees, accountants and attorneys that you can ask questions to, tax preparers, those type of people. Interest on mortgages. This would also be the if you kept a separate credit card and the only thing you use it for is your rental property. You never charge anything personal on it. It's rental properties only. This is one of the places you could deduct that credit card interest because it would be related to the rental. You can't deduct the credit card interest or other interest if it is of personal nature or it's commingled with personal responsibilities. Any repairs to the property, supplies, taxes, utilities on the property, and all sorts of other things, from the bank charges you pay to the dues for, Professional Landlord magazine to the credit reporting fees, everything, including your postage, your permits. If your rental isn't local, the travel expense to get there and check on it and oversee it on occasion, just again, needs to be reasonable and customary. And of course, any kind of condo fees if you're in an association and your rentals in an association. I told you before that if you move somebody into your house, it's going to fall down in 27 and a half years. We call that depreciation. You must use the depreciation on rental. You can't decide I don't need the expense, because when you sell a rental, you have to recapture depreciation even if you didn't take the deduction. So having it out there is important. Residential rentals are straight line depreciated, which basically means you divide them by 27 and a half, and that's how much you take every year. If it's non-residential, they say it's going to fall down in 39 years. So you divide by 39. My triplex is a residential rental. Depreciation, I depreciate it over 27 and a half years. I have a brilliant idea. I am going to use my triplex for short-term rentals with Airbnb and a number of other companies. I'm going to rent it out. I'm going to make a lot more money. I'm going to provide some services to my triplex. I'll go in and change the sheets, and I'll do travel, and I'll put some services in. Oops, my triplex just moved over to Schedule C. It's no longer a rental activity. It's now a business activity. It's also no longer a residential rental. It's now a non-residential rental, which means instead of 27 and a half years, I need to use 39 years and divide it by 39 years to do my depreciation. That can change. You can see a lot of things happen if an activity moves from being a residential. The same thing, my commercial building is 39 years because it's not residential. It is a commercial building. My warehouses, 39 years. Now, if you have improvements to land improvements, things like sidewalks, roads, drainage facilities, bridges, fences, landscaping, you write those things off over 15 years. They don't have to take the full term. Their useful life is considered by the IRS to be 15 years. And things like appliances, carpeting, those are 5-year. Furniture, that's 5-year property that you're going to be able to write it off over 5 years or maybe even expense it. Understanding how, and there's also the ability to do what they call component depreciation. I bought usually a commercial building or a large rental. What I really bought is a building shell, but it's got plumbing systems and it's got electrical systems and it's got other systems in it that I can depreciate faster. I might want to do that, especially if I had other large taxable income that I could offset. Not really a great thing in most cases, but component depreciation, cost segregation studies analysis can work when used with the right property. The important thing to remember with depreciation is it is not a gift from God. You're going to have to recapture it. So if I own my residential rental for 27 and a half years, and I take depreciation every year for 27 and a half years, when I go to sell it, I'm going to have no value, no cost basis, no tax basis in the building. May still have some in the land because it doesn't actually depreciate on its own, but I'm going to have to recapture that depreciation. So I bought my residential rental. I paid $200,000 for it. Great. I depreciated it down. I took depreciation. I'm going to assume half and half to make this easy. I took $100,000, divided it by 27.5, deducted it for 27 and a half years. I go to sell my rental. I still now have $100,000 land value. I have $100,000 I paid for the building, less $100,000 I wrote off, so zero. I sell it for $200,000, the exact same thing that I paid for it. I now have a $100,000 gain because I only had a $100,000 basis. I sold it for $2. I got to pay tax on the $100,000 gain. So just remember that when we sell, we're going to get hit. That depreciation comes back, makes the gain bigger. Good news is it's going to be a capital gain at a lower rate if all things stay as they are now. There is also a provision that you can make an election called a de minimis safe harbor election. This is an election that is made on a form that goes in your tax return. It's just a statement you put in, and it allows you, for most landlords, to not depreciate any single item that would be depreciable. It's got more than a useful life of 12 months, and as long as the cost of that item was under $2,500. Now, we really like this because it means we're not carrying a dishwasher for 5 years and carpeting for 5 years and hot water heaters. We're being able to expense those when our clients buy them, but we have to make sure that we make this de minimis safe harbor election in regard to expensing those items. It's really, as I say, it's a really simple election to make. Lets you deduct those things as repairs as opposed to having to depreciate them. And it will make your life much easier and probably save you some taxes. Okay, so how do you track all this stuff? If you take a look, I have this wonderful form we've designed called an E1. You email us a request, we will send you the form E1, but you'll note I have a whole bunch of things listed under income. Then I have expenses. There's little dots out there. The dots are what go on the tax return. They come over to the tax return, which I have a copy of the Schedule E here for you to look at. But I want to remind my clients when I ask them about repairs, for example, on the top right-hand side, I'm going to say, did you have any repairs? You up? Great. Okay, does that include your heating and air conditioning? Does that include any repairs to your appliances? How about lighting? How about your pool, your roof, carpentry? What else do you have? Because what I find is when I ask people direct questions about direct items, they tend to remember things that they didn't record or didn't do, and they can go back and I pick up typically anywhere from 15 to 20% more deductible expenses by doing that. So, the same way when I go through utilities, people, oh yeah, we had to pay. And then you ask, did you pay electric? Oh yeah, we didn't have it rented for 3 months. We paid the electric for those 3 months. Oh, did you have to pay water? Yeah, our tenants stuck us with a bill when they left and we had to pay that. So even if they're not regular expenses that they have, just if you go through this, the list is designed to help jog your memory about things that might have happened a while ago and you've forgotten or that you didn't realize were deductible. Certainly, they total to certain groups and go together, and then they go on to Schedule E. I want you to note on Schedule E that there's some new stuff that's been added in the last year or so. At the top, question A, did you make any payments in 2020 that would require you to file Form 1099? So if you paid any people for service and you paid them $600 or more during the year, if you paid anybody other than a corporation, total gross amount of $600 or more, you need to file 1099s. And if you say yes here and you don't file the 1099s, you're probably going to end up with 2 or 3 points towards being on the audit list of your friendly neighborhood IRS. You need to do the 1099s. Now they're asking you to verify that you did them. And if you say, no, you didn't pay anybody, and they look down your expenses and they see, oh, contract labor, it's going to tell them that, hey, what is this contract labor and who did you pay? So you might want to be careful about that. They're now asking about that on all the business returns. They're also asking you if you said, yes, you paid these people, have the forms been filed? So they want to know that. Of course, they want the physical address of the property. They want the type of property it is, and there's some explanations for that in the form. And if you're have any personal use, the number of days rented, the number of days it was fair market rented, the number of days it was personal use. And again, we talked about husband and wife, spouse partnerships, being able to file on the Schedule E if it's a qualified joint venture, and they want to know if this is a qualified joint venture. They're asking you to check the box. They're also giving you the information. Here you see rental information and expenses. And I just want everybody to be familiar with this. We have property A, property B, property C. If we have property D, we just use another schedule. You should be familiar with this. This is important stuff. If you're a landlord, certainly you can get a copy of our form. We're happy to give it to you. You may also want to look at the supplemental income and loss Schedule E that the IRS has in the instructions, because not that I think you should do your own tax return. I think that would be foolish. You're really better off getting somebody that knows rental property and how to deal with it. But at least you're familiar with what the questions are going to be and what the IRS is looking at. COVID-19, I've told you, We have in all sorts of places these eviction moratoriums. I don't really understand how the government can tell a landlord that he can't collect rent, and that is in effect taking your property. Seems unconstitutional to me. I did not get a PhD in constitutional law, so I'm not going to say whether I'm right or wrong, but it certainly doesn't seem right to me when you still have to pay your expenses. But it does mean that we may see less rental income. The bad news is, because of the passive activity rules, unlike ordinary businesses that will be able to carry these losses back 2 years and get refunds for 2019 and 2018, you're going to have to carry these losses forwards. Anything over 25,000, even that amount you won't get depending on your income. You're going to have to carry these losses forward until such time as you do one of two things. Thing number one is you have profits, and then you can offset the profits and not have to pay the tax when you earn them. Thing number two is completely dispose of the rental activity. So sell the property and be done with it, and then the losses are released and deductible against your other income. But you're not, like other business owners, because of the passive activity rules, going to be able to go back and generate refunds to help make up some of that lost revenue. We are hopeful that Congress will understand that. In the COVID-19 update, I've written some stuff up and sent them out and had them published in various places that publish things that I write. But I can't make Congress do anything. I'm not sure whether anybody can. And the reality here is that the tax law was changed in 1986 to stop owners of real property from using the losses to offset other income. And while that may have been okay if you're a high income person who's operating a property, so you could take advantage of the tax losses, especially at much higher tax brackets than we have today, it really is unfair. If I lose money in my restaurant, if I lose money in my accounting business, if I lose money in any business, part of the COVID-19 legislation, the CARES Act, it allows me to carry back those losses and free up tax refunds from other years that I had income in. That's not available for those of you that are rental property, investment property holders. Lost rents, as I told you, they're going to be uncollectible. They don't ever go into your income, so they're going to increase a lot of these passive activity loss carry forwards. There are going to be a lot of people that are going to have so much in losses they carry forward that it may even make sense to sell the property because it'll offset large parts of the gain or all of the gain. We'll see that. One of the few COVID-19 provisions available to landlords is the ability to defer mortgage payments. That is, if your mortgage is FDIC insured, if you have the right mortgages, you may be able to defer the interest in the mortgage payment. However, this deferral only delays till later the amount you're going to pay. Most of this deferral is going to go on the back end of the mortgage. Your 30-year mortgage just became a 32-year mortgage or a 31-year mortgage, but you should check with your lending institution, especially if you're having problems collecting your rent. Is there a deferral that you can do for your mortgage interest that'll reduce or eliminate the amount you have to pay until such time as they resolve all this stuff, or at least until such time as you can evict and collect? So I just wanted to do a little example of how the COVID-19 affects. I talked about this earlier, and I'm using the Schedule E, but the reality is we have property A here is my property in the perfect world. I get $1,000 a month in rent. I collected my $12,000. I paid $500 to clean the property and $900 and so on. So my total expenses are $10,109, including my depreciation I'm writing off on this property. That means I have taxable income from the property of $1,891. Don't have to worry about passive loss rules. I don't have any of those for this property out there. I'm in great shape. I'm going to take this money that I'm making and I'm making a profit. Oh, we just rolled into 2020 and we want to get out as fast as possible. My tenants stop paying rent in June. They don't pay any rent for the rest of the year. I only collect $6,000. They stay there. I'm still having to take care of the place and do everything. My expenses stay exactly the same. I now have a $4,109 loss on my property. If this is my total passive losses and I meet the requirement, it's under $125,000, great, I can deduct the loss. If my income is over $150,000 married filing joint, I have to suspend this loss and wait till later to deduct it. But you can see that the change in the net income means I have less taxable income because I'm not collecting the rent that is owed to me. If next year God smiles upon me and I get the rent, that's great. They pay me the $6,000 in back rent. Well, next year I'm going to have $18,000 then in rent income. Hi, this is Steve Weil, and you've reached the end of part 3, but not to worry, part 4 will be ready soon.